Hello everybody. So today is not the planned video. I was going to do a video telling you all the good I think about the HIMS conference call and how excited I am about HIMS. But guess what? I can't do that today because I have to talk about fear winning, because today fear is winning in the market, and we don't have a quite good idea as to why the fear is winning. But if you look at the market, everything is crashing across the board. Every so-called risk-on asset, which makes no sense because to me those risk-on assets that the traditional market calls risk-on, I call them risk-off. But it seems like all of these are crashing. All of the old world stuff is doing apparently seemingly well. All of these slower growth companies, even bonds are up today. It's your typical market nonsense, your typical risk off trade. You sell the risk on assets and you buy the risk off, and it's so short term and it makes no sense to me. And it seems we don't know why it's crashing like that, but of course CNBC is trying to guess, and CNBC goes back and forth between saying, "Oh, it's because of Trump saying the tariff will go forward." Never mind. I think it's probably a negotiation tactic because we are due to go forward next week. That hasn't changed. But if you remember the last time the tariffs were supposed to go forward, he changed his mind the day off. The day off he's changed his mind. So how do we know he's not going to change his mind the day off next week? The market keeps reacting on these short-term moves. And then the other one is, of course, the confidence. The February, the confidence report, always saying, oh, the biggest drop since 2021. But guess what? They would have found something negative to focus on and to report on. They always find the most negative aspect of these reports and then they put it in the headline. You may remember last week I thought the CPI was just fine, but the eggs were getting more expensive. So everybody was reporting on the cost of eggs. It's like the media, the market always finds a way to pick the most negative aspect of a piece of news and you put it forward and you ignore all of the positives. And so now the talk is about the recession fears, the talk is about the tariffs, and to me this makes absolutely no sense, because to me we have perhaps one of the best setup that I've ever seen. We have a president who's openly talking about a Bitcoin reserve. We have a president who's openly cutting spending, cutting billions and billions of dollars. We have talks of tax cuts. We have talks of paychecks, like a $5,000 check going to Americans from the Doge initiative. I don't know if it's going to happen. Maybe it's not going to happen. The point is, we have this very, very positive narrative all around, and the market, as negative as it is still focusing on the awful thing. To me, the only thing in the macro that's not doing well right now is Jay Powell. Jay Powell's got to go, and he doesn't want to go. The rates have to go down. Jay Powell's going to go. That's the only negative. But that negative is the only negative that remains from the past 5 years that we've had, 2022, 2023, 2024. We had so many more negatives. And not to mention the possible end of the Ukraine conflict. Like, we have so many positives right now, and the market is just nitpicking into this fear. It's the life of a growth investor to try to not to react to this, and that's why it's important to stick to rules, and I'll get to these rules at the end of the video. But to me, this makes absolutely no sense. So my favorite stocks are way down today. HIMS is down, what is it? So HIMS from a peak is down 44%. I think HIMS is down today something like 30% or something like that, after, frankly, a absolutely stellar earnings. Tesla is down. Who knows why Tesla is down? They had amazing news yesterday. They're launching FSD in China. Tesla is launching robotaxi in Austin earlier than most people thought. This company, all of the good news of the unlock of the cybercab and robotaxi business is moving forward, and the stock has just been crashing. So it's just absolute nonsense. Microstrategy is down way more than Bitcoin. Now, that's a feature, not a bug. We know that since Bitcoin is at 87, 88, we knew that MicroStrategy would drop more. So that right there, I would not put it as an anomaly, more like a feature and not a bug. But still, on a price to NAV basis, MicroStrategy has been getting way too cheap, in my opinion. This is a stock that's being heavily sold off. And the QQQ, notice on how I zoomed out here on the QQQ. Actually, on the QQQ, if you look, it's only down 5% from the peak. So the QQQ, so-called unstable, highly volatile asset is really not that volatile compared to all of the assets that I follow on the channel. So let me go towards more specific stocks. So what's perceived risky as the legacy market is not perceived risky by me. Let me show you an example here. So this is HIMS. Of course, HIMS is a top stocks on the channel. I love HIMS very much for this channel, and I've covered it a long time. It's a big position for me. HIMS is trading at $36, down 29% on the day. HIMS has zero debt, and a market cap of $10 billion. Look at CVS. CVS is up today. CVS, the company that announced it was closing 2,000 stores. What was it? 2,100 stores they announced they were closing. But was it 3 weeks ago they announced that? CVS is up today. Yeah, CVS is a safe stock. It's a safe company. Oh yeah, CVS has $83 billion of debt for a $79 billion market cap. So the value of CVS is less than the value of its debt, and it's up today. So whoever is in the safe stocks today, the safe stocks for the short run are not the same thing, in my view, as the safe stocks for the long run. And so that's why we have to be comfortable with volatility. You have to be comfortable with volatility, because I remember buying HIMS at $6. And now, despite this awful drawdown of almost 50% from the peak, it's still up a 6 or a 7x compared to buying it at $6. And that was 2 years ago that HIMS was trading at $6, right? If you look at the long-term performance of HIMS compared to CVS, compared to the moment HIMS did the SPAC, right? So that's not even fair, because during the early years of the SPAC of HIMS, there was nothing happening. So I don't even take into account the nearly 2 years of nothing happening for HIMS stock. You can see HIMS stocks return 35%, so almost twice as good as the NASDAQ. And CVS returned a 2.9%, so you didn't even beat the bonds. You are losing money with CVS, but not on a day like today. On a day like today, you're gaining, because the market is so short-term, and the market think it's all about the short term, as always. This hasn't changed. Here's another one. I'm very bullish on Tesla. Tesla is my most controversial stock, and I'm happy about that, because if you pick a controversial stock, if people don't agree with your stock, that means you're onto something. That means you're at the edge. That means you're at the disrupting edge. And I know in my channel a lot of people disagree on Tesla. A lot of people agree on Tesla too. Anyways, that's not the point, whether we agree or not on Tesla. The point is, part of today's news, people are saying that tariffs are going to be in place against Canada and against Mexico. So explain to me why Ford is up today on a day where the tariffs are supposed to come in place next week on Canada and Mexico. Who's going to be hurt between Ford and Tesla with the tariffs on Canada and Mexico? Who manufactures? Ford has plants in Canada. Ford has plants in Mexico. Ford doesn't have any, Tesla doesn't have any such thing. Tesla only manufactures in the USA. So who do you think is going to be impacted the most? It's clearly Ford is going to be impacted the most. Yet Ford is up. To tell you how much the market makes absolutely no sense. Ford is up today. A company that still sells only through dealerships. A company that has not taken the turn of electric, only sells through dealerships. Right? Not a line for 21st century business. It's up today. Tesla's down 8%. Ford is up 0.64%. And even if we're not even to talk about the tariffs, forget about the tariffs. Just think of it from a first principles basis. Ford's debt is $161 billion. The market cap is $37 billion. 161 B. How are you going to repay that? Yeah, right? Who has huge growth? Do you have huge growth? No, there's no growth there. That's a zombie company. That's the very definition of a zombie company. When you have 37 billion in market cap, 161 billion in debt. Tesla, on the other hand, the debt is nothing to speak of, because the market cap is essentially $1 trillion and the debt is 13 billion. So the debt at Tesla is 0.01%. That's how little, 0.1%, sorry, 0.1%. Anyways, there's essentially no debt for Tesla. And for Ford, the debt is more about 5 times the market cap. So it makes absolutely no sense. And of course, over the short term, a legacy company is winning with this market crash because it's the established company and it's considered safe. But if you look over the long run, of course, the returns are stark with Ford at 3% return, 3.9, I'll call it 4%. You didn't beat the bonds right there. And Tesla, you're at 43% return. So you are at close to 2.5 times the NASDAQ for Tesla, 2.5 times the NASDAQ for Tesla. So anyways, this market absolutely makes no sense. And absolutely, Bitcoin, of course, is the stock that is. Bitcoin is not a stock, but Bitcoin is down only 18% from the peak. So actually, I still believe that Bitcoin is way less volatile than it used to be. But MicroStrategy, by way of its design, MicroStrategy is down more than Bitcoin. This is not the same period, but almost the same period. You can see Bitcoin was down 18%, MicroStrategy was down 46% over the same period, roughly. So MicroStrategy is roughly twice the volatility of Bitcoin, and so the drop of MicroStrategy today, perhaps slightly warranted, but really not that much because of a price to NAV basis. It keeps going down on a price to NAV. Now MicroStrategy is at a 0.48 on a price to NAV basis, and this stock is just looking so cheap. And I think this is temporary. Obviously, Mara. Look at Mara. Mara is only trading at 1.06x Bitcoin to NAV. So that means that Mara is only trading 6% more than the Bitcoin on the balance sheet. That means that if Mara were to trade at 0.99 or 0.98 Bitcoin NAV premium, then it would make sense for Mara to just go ahead and buy back its stock. This is how silly this has become. And if you look at the total return, this is the same story as always. Now, of course, it's almost unfair to compare Bitcoin to the NASDAQ. When you have top investors like Larry Fink, etc., saying 2% Bitcoin in a portfolio might not be a bad idea. But if you look at that MicroStrategy versus the QQQ, over the past 4.5 years, it's been 98.5% return, yearly return, average annual return, versus the NASDAQ at 16% return. So what is it? Are we a 67x more return on MicroStrategy? Think about that. That's absolutely crazy. And if you look at Bitcoin, and again, this is unfair because the only ticker I have is GBTC, and GBTC started mid-2015. But if you look at Bitcoin was 66% annual return over the past 10 years. NASDAQ was 18% over the past 10 years. So this, again, shows, in my view, that the harder asset drops on days like this, the better off this asset over the long run performs. And there is this discrepancy between the assets that make you feel good today. On a day like today, the assets that make you feel good about your portfolio, they are those assets which over a 10-year period do not make you feel good at all about the performance of your returns and of your portfolio. And I'll conclude this with one of the hallmark examples of this. Any investing books talks about this. I asked Grok about it because I couldn't find a chart on Google on this one. But Amazon, right? Amazon, poster child of volatile companies. Amazon is a company that on its entire career, and still today by some investor funds, it has been called overvalued. If you followed the stock market for the past 20 years, there's never been a time where Amazon has not been called nosebleed overvaluation. It's always been called very, very overvalued. And Amazon, of course, is one of the top performing stocks out there. Amazon has known over a 20-year period, 16 drawdowns exceeding 20%. And I didn't put it in there, but Grok also goes at free drawdowns for Amazon. Free drawdowns exceeding 50%. So 20%, 50%, 16 of them. So that means a high performance asset, you can expect, at the very least, a 20% pullback in a day every year for maybe 10, 15 years is what that means. And that's because of the nature of the volatility. And this is why, and on a day like this where actually bonds are up, which makes absolutely no sense given the state of the debt in the world and the state of monetary policy and the brink of bankruptcy of so many companies are on with their debt, the counterparty risk associated in the debt. I'd be curious to dig into TLT and seeing how many of these bonds have huge counterparty risk because, that debt cannot be repaid. Would you like to be on the receiving end of the debt of Walgreens, for example? Would you like to own the debt of GM? Would you like to be on the receiving end of that debt? Are you confident the principal is going to be paid back? And so people are bidding up the debt, right? As if debt didn't have counterparty risk. Anyways, this has led me to a few rules because of this volatility. First of all, very little margin use. I'm not dogmatic. I don't say zero margin, but very little. It's important to be very reasonable with the margin, if any. But 10% of your margin on your broker. If you use maximum 10%, I think that's the way to go. But that's just me. Some people may say 20%, but what's for sure is that if you use too much margin, you're going to be margin called. That's for sure. So be very careful with the margin. That's point number one. Use very little margin. Like I said, I'm not dogmatic. A little bit can enhance returns, but just a little bit, like 10%, no more. Anyways, that's point number one. Point number two, daily DCA. So this is what I do. You can do weekly DCA or monthly DCA if you're okay with that. But daily DCA is what I do. And there's this endless debate as to whether DCA versus lump sum investing. Some people say, if you get a lump sum of money, you should invest it all at once. And other people say, you should just DCA, invest it, monthly, weekly, whatever. To me, the best way I found about it, because, I'm a net buyer of stock for the foreseeable future, and I think most of the viewers of my channel are going to be net buyers of stock for the foreseeable future. I mean, really, the only time in your life really where you're going to be a net seller of stocks is going to be maybe in your 70s, maybe. But if you have a career and all of that, you're likely going to be a net buyer of stocks for a very long time. So as a net buyer of stocks, to me, I believe in daily DCA. So what you do is you take your yearly amount and you divide it by, the number of trading days, right? Or you take your monthly amount of investing and you divide it by 21. And then you got your rough amount of money that you want to invest in each day. And you just buy a little bit each day. And this is how I manage my itch, because I have the itch to buy. I cannot tell you how many times I see a stock and I'm like, it's so cheap. And sometimes you have the itch, you're like, I'm going to go all in because it's so cheap. Well, this daily DCA, protects you from yourself. For example, I'll give you a very clear example. And if you're on the Patreon, you know this. I shared this on Patreon. Yesterday, I bought some MSTR at $2.85. I was quite happy. I thought it was so cheap. I put my daily DCA amount. And I will get to nibble again at $2.50 today, and the key is going to be to try to stick to my daily DCA, because I might be tempting to do a double or 5 times my daily DCA. We'll see, but you want to be very, very careful with that. What's for sure is that if you have a daily DCA amount, you don't want to do 50 times your daily DCA on the one day you think is the low point, or is the bottom. That's at least my take on this. And then lastly, this is the last takeaway. This is one of my rules: is volatility is the price to pay for higher returns. You have to pay volatility for higher returns. Volatility is vitality, as Saylor says. That's a great way to say it, but the volatility is the price that you pay for higher returns. And so if your portfolio doesn't have a big drawdown right now, maybe this is not the YouTube channel for you. Maybe this YouTube channel is a little too out on the risk curve for you, because most of the stocks that I cover are down today. Why? Because they are these high growth companies, these innovative companies, these companies that are still misunderstood. And so if they are still misunderstood, they're going to be on the edge of the risk curve, unlike, say, the TLT, which is not risky. And, I'm smiling right now. Not risky, right? It all matters. It all matters on your. It's all about the long run, right? Over the long run, I believe growth stocks are the way to go. So, anyways, this was obviously not financial advice, not investment advice, and you understand why I say this on days like this, and I'm happy that I keep repeating it in every video. Never financial advice. This is just what I do. This is just entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.